everyone. It's Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the market insights for Friday, January 8th. Greetings, everyone, and welcome back to our daily videos. I hope you had an enjoyable New Year's holiday and are looking forward to trading the markets in 2016 with hope and enthusiasm. Now, this first comment of the year is always the most fun one for me. I'm going to compare what the market was forecasting for 2015 with what actually happened. The result, as usual, was that the pundits did poorly. Flipping a coin would have resulted in a pretty similar result and only cost you whatever the coin was worth. To start with, here's a graph comparing what the market forecast the spot return would be for each of 31 major currencies against the dollar on the y-axis, against what the spot return actually was on the x-axis. The spot return is just the change in the price of the currency. If the market forecast was exactly correct, then the dot would fall on the yellow line. The results were not particularly inspiring. The market only got the direction against the dollar of 17 of the 31 currencies correct, or about 55%. This is more or less what you'd get and what you'd expect to get just by flipping a coin. The biggest errors were the Brazilian real, the South African rand, the Colombian peso, Russian ruble, the Mexican peso, and the Turkish lira. This suggests that the slowdown in China and its impact on commodity prices was a big surprise to the FX market, as was the continued plunge in oil prices. Also note that almost all the currencies are either on or above the yellow line, meaning that they either met or were weaker than the market consensus. Only the Swiss franc, which abandoned its peg against the euro, and the yen performed better than expected. That shows how the market underestimated the dollar's rally in general. If we look at the total return, which is the spot return plus interest income, the picture is even worse. In this case, the market got only 13 of 30 currencies correct, or 43%. Apparently, the errors in forecasting interest rates were added on to the errors in forecasting currency rates rather than canceling each other out. The Russian ruble was the major outlier. The market expected a total return of 45%, but in fact it lost 8.5%. Many of the other commodity currencies also did much worse than expected on a total return basis. One interesting point, the Argentinian peso had the worst spot return, down 35%, but the best total return, plus 13%, of any of the currencies. It happened in 2013 as well, that the Argentinian peso was both the worst performing and the best performing major currency in the world at the same time. Now, this analysis could be depressing for retail investors. You might think, if the highly paid experts working at the big investment banks who spend all their time thinking about FX can't do any better than flipping a coin, how on earth can you? But I looked at it the other way. This analysis suggests that even an amateur has a fighting chance against the experts because the experts, and I include myself in this group, don't really know for sure what will happen either. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.